value, instead of 1.2 million, it grew to 2.3 million. Oh, the power of time and compounding. And that's why I think it's so important that we teach our young people to be financially literate. Because if they can do this right from day one, they're sitting in the catbird seat. I'll tell you, if they just have the discipline and do the right thing. And the neat thing is, the right thing, according to all of the folks that I know that I consider to be truth tellers, it's really a low risk to invest. But it still suggests that in the early years, at least the first 20 years, no bonds. We don't want something that's earning 3.3%. We want something that has a legitimate 10% compound rate of return, or even 11. And in just a second, I'm going to show you how easy it is to make 11 with the S&P 500. Stay tuned. Now we have, remember, 4 levels of risk. We have another level, that's the small companies, small cap blend. These big companies are 100, 200, 500 billion and more. These companies are maybe 8 billion down to 2 billion. So they're smaller companies. And there's all sorts of ways why they're more risky. You don't want to buy them one at a time. But as a group, like an index fund, these are a great thing to have in your portfolio, at least based on the past. And I'm going to show you a chart that I hope you will never forget. As a matter of fact, I hope you will come revisit that chart once a year, because we update this chart every year. But notice the $100 grows to almost 5.5 million, an 11.9% compound rate of return. Now, the small cap value, it's here. It is risky. Like the long-term bond is risky, small cap value is risky. But there was a premium historically for that risk, 13.2%. Now, I am not for a second promise you 10 or 11 or 12 or 13, because it's not unlikely that all of these will pay less. We don't know. We don't know. I heard Bill Gates interviewed last night, and he talked about artificial intelligence and how it is many, many times more important to our future than the invention of the desktop computer. Now, that's a pretty strong statement. And so who can know what life will look like 30, 40 years from now? But I do know this, that unlike bonds that had a very narrow best and worst, 1 year at a time, there's about a 90% difference between the best and the worst for the S&P 500. It's about 150% difference for large cap value from best to worst. For small cap blend, it's about 160% difference from best to worst. And small cap value is about 180% difference from best to worst. So if you ask me what I think the market's going to do this next year or this year, it will be somewhere in between these numbers. And in fact, I would like to believe that it will start to look more like somewhere in between the 15-year return differences, where instead of having 90% difference, the best and worst difference is about less than 20% for large cap blend. Large cap value, which was like 150% difference, is now around 20% difference, 21%. And even if we go over to small cap value, that was just absolutely huge, now the difference is down to about 27, 28%. What I'm saying is that the longer you hold, investments like these, the more narrow the outcome becomes. And so when we're talking to young people in their 20s, we're talking about 40 years. When we're talking about people like myself, we're talking about 10 years. And I'll show you in a while a bunch of 10-year results that I think you'll find interesting. So here's what we know about 40 years. The very best for the S&P 500 was 12.5%, and the worst was 8.9. Now that's a fairly narrow range. And I think I could live with that as upside and downside risk for money that I'm putting aside for retirement. I'll be writing an article, we will be writing an article in the coming months about all equity all your life. And we're also going to talk about all 60/40, 60% equity, 40% bonds your whole life. I think you'll find those studies very interesting. But here I'm talking only equity. So you can compare these four different levels of risk. Now, the first thing I want you to see is that the average compound rate of return of the S&P 500 over the last 58 40-year periods is in fact 11%. I told you I would show you how easy it is to make 11. And the reason it jumps from 10.2 to 11 is because you had a handful of years back in 29, 30, 31, 32. The market was just miserable. And of course, when you're looking at very long periods of time, okay, your first year includes, let's say, all four of those terrible years. The next year, you start the second year and you go to the 41st year. Now you only have to suffer one of those bad years. After you get by those four bad years, everything looks much rosier. But they are real. And it isn't unlikely that that will again happen in you, particularly for young people in their future. But I want you to notice what happens here. The range of returns, 11 for the S&P 500, the balance of large cap growth and value is 11 and then 13.4 for large cap value. Then for small cap blend, it's not much more, 13.6. And for small cap value, 16. And of course, those are absolutely huge numbers over a lifetime. I do not expect small cap value to compound at 16% over 40 years. I do think that 12 is a possibility. I know as I look back at the last 25 years, the small cap value fund that I've been working with has been around since 2000, and another one's been around since 1993. But since 2000 in particular, it's been a tough market for the S&P 500. It's been about a 8.8% return, not 11, not 12, not 10. And small cap value has been about a 10.2% or 10.5, I'm guessing now, but a little over 10 instead of the longer term return. The last 25 years has been a very difficult market. Oh, yeah, sometimes it's been good, and sometimes it has just been terrible. Now, I have not been talking about these other returns over here because I'm going to do that in just a few minutes. But I do want you to see that the premium for risk for large cap value, small cap blend, small cap value is it's overwhelming evidence. But this is the long term. When you invest the long term, while you might think about it and remember that's what it's all about, staying the course for the long term. But short term does have an impact on investors. I was an investment uh, advisor for many years. I started an investment advisory firm in 1983. And what I found, because you get to know your customers really well as an advisor, when you're going through the period of exploration to understand how they got to where they are today and what lessons they learned along the way, and sometimes those lessons were what I call myths of investing, but doesn't mean that you can't believe in a myth. And what I found was that if I told somebody about a strategy, that it was a combination of large and small and value and growth and US and international, if in the first year or two it did well, they were very likely to be an account for a very long time. On the other hand, if you put people into a portfolio and the first thing that happens is like 1973 and 74, like 2000 through 2002, like 2009 through, 2007 through the early part of 2009. Many of those people don't want anything to do with equities ever again because they experienced the downside. If people have made money before they have to face the downside, they are so much more likely to stay the course. So, what do we know here about diversification? I started in the business for a couple of years back in the 1960s. I was a stockbroker. And they sent us away to a fancy school back east. Well, it had a fancy name anyway, the New York Institute of Finance. It was really a sales class on how to sell securities. But they did teach us some things. And one of the things they taught us is that to have a properly diversified portfolio, you only need 10 to 20 stocks. Well, the academics disagree vehemently. Later on, it was determined that if you were going to put money, let's say, into large cap blend or small cap value, or these different equity asset classes, that you needed to have 100 stocks to eliminate the risk of a company going broke and having a serious impact on your portfolio. On the other hand, you can have 1,000 companies in your portfolio, and it doesn't do anything to protect you against market risk. Market risk 73, 74, 2000, 2002, 2007, 2009. In all three of those periods, the market was down 50% or more, somewhere in there. And on October 19th, 1987, the market went down over 22% in one day. That was unsettling. And many people thought it was the start of another depression. So diversification is really important. And as I mentioned earlier, the way to own stocks, because they are so risky one at a time, is to own many, lots of many. It is a good idea to own, if you can, 2, 3, 4, 5,000 companies. But I don't want you to own them in one asset class. I want you to have many asset classes. Remember, I talked about large blend. I want you to have it. Large value, I want you to have it as a separate part of your portfolio. Small blend, yes, that too. And certainly small value because it has been the gold ring of equity asset classes